We need to talk about money printing. So is what's happening right now money printing? Not exactly, but it's close. See, whenever something like this happens, people all over YouTube say that the US is printing money again. And I get it. It's because it's easier than explaining all this complex crap that I've just been through. But it's not really the same as printing it again. That being said, the effects are kind of the same in the end. Printing money means that the Federal Reserve creates brand new dollars that didn't exist before and buys bonds with them. New money out of nothing. Now, the Treasury can't do that on its own. They can't just create money out of nothing. In reality, every dollar that the Treasury spends on a buyback is a dollar that it borrowed from somewhere else first. But the effect is kind of the same. See, the reason QE or money printing pushes long-term rates down isn't the money itself. It's that the central bank takes 30-year bonds off of the market. So there are fewer of them left for everyone else to hold. Fewer bonds means that the yield on those bonds goes down, meaning that that 5.3% number they are desperately wanting to go down starts falling. The Treasury just did exactly that. They took 30-year bonds off the market. Now there's fewer left and yields fell. They already are down from 5.33% this morning to about 5.2%. That is just today. So when QE happens, new money is being printed to buy bonds. What's happening today is more like new money is being borrowed to buy bonds. But either way, bond rates fall just like they did today. And look, I don't care much what we call it. What matters is the direction. The direction is a government that has decided it cannot live with that 5% long-term rate anymore and is now doing something about it. And by the way, another reason why the market is reacting like this, like it is right now, is because this could turn into QE. They've shown that they are desperate enough to do this in order to bring rates down. If this doesn't work, they might need to ramp things up and then this turns into QE. But why is this good for gold? That's the big question, because of what the Treasury just told us about itself. They didn't announce this at a press conference. They put it out in a document the day after the worst bond market reading since 2007. It signals that they are desperate, they are cracking. And the program conveniently ends on the 4th of November, which is also interesting. The midterm elections are on the 3rd of November. Is that a coincidence? I don't really think so. So why would they care about that date? Because the long end of the bond market sets the cost of borrowing for everyone else, mortgages especially. American mortgage rates are set around 6.7% right now, which is pretty bad. And they follow these long-term yields, that 5.33% number. So if the 30-year keeps climbing, mortgages climb along with it, and millions of voters feel that in the month before they vote, which isn't great for the government right now. It isn't great for Trump. So the government is scared of that 5.3% number. Trump is scared of it. And once you know that they are scared of that number, you know how this ends. They just showed their hand. A government that has moved on to short-term borrowing needs the short-term rate to be low, desperately, because every single year it has to go back and borrow the whole lot again, which means the pressure on the Fed to cut is now permanent. Whatever Kevin Walsh says about hiking rates, the debt decides that this is not going to happen anymore. And that's Kevin Walsh's big problem right now. And when they cut into inflation, because inflation hasn't gone away, you get the thing that I've been banging on about for years. You get interest rates that are lower than inflation, and that is really bad, but it's really good for gold, by the way. That's called your real rate. So the interest rate you earn minus inflation. So right now you get about 3.6% on short-term government debt, the Treasury bills that we've been talking about, right? Meanwhile, inflation is sat at about 3.3%. So you're making about 0.3%. It's positive. It's basically nothing, but it's still positive. Now watch what happens when they cut. Drop that 3.6% down to 2.5% if they cut interest rates, while inflation is still sat at 3.3%. And your real rate goes negative. At that point, you're losing value every single year just by holding dollars. And there is nowhere to hide from it because it's money. It's the money itself doing that. That's the environment gold exists for. Everyone thinks gold is a war trade or a crash trade, and it really isn't. It's a debasement trade. So gold works when the people who issue the currency need that currency to be worth less, which is kind of happening right now. Quick thing before you go, I've written a free guide called How to Retire Before 2036. It's a full 10-year plan for anyone starting late. Get out of debt, invest properly, retire on time. Free download, link in the description.